we are going to be doing another breakdown of a company that has been publicly traded for a little bit, and that is Docusign. This is another software as a services company. And Brian, I know how much you love the SaaS space, so I had to bring you on to talk about them.
Absolutely. I love SaaS companies, and Docusign is a recent IPO, and I went through my checklist on them, and I think there's a lot to like about this business.
Yeah, when we did that episode on Upwork a little while back, we got so much positive listener feedback on your approach that it only made sense to do this again. Why don't we start out with the backstory on this company, how they got to where they are now?
Sure. So Docusign, as I'm sure many listeners know, they are a leader in the move to e-signatures. So Docusign was founded in 2003 by an entrepreneur named Ton Gosner, and he looked around the world and he saw that everything was going digital, but the a foundational business process, which is like the agreement where two sides of a parties agree to some terms, that was still done using pen and paper, and that process had not been updated in centuries. So he decided to disrupt the process, and he founded Docusign with the goal of moving the entire agreement online. And the opportunity that he saw would be, if you could move it online, you would make it far faster, lower cost, and you would greatly improve accuracy over the traditional way. And if you look at Docusign today, they now have hundreds of thousands of customers that pay them for their services, and millions of people have used Docusign in one way or another. So they have been wildly successful.
Yeah, and not only have we researched this company, we are users of the platform. I have used it to make some signatures for Fool internal stuff, and I know you've used it as well, Brian.
Yeah, I used it actually just this week to open up a new account with Vanguard. And when I was on the phone with the rep trying to open my account, he told me that he was going to send me a DocuSign. So I think there's an argument to be made that the name has become synonymous with the product.
Yeah, and we love to see that as investors because it means that a company has a pretty good foothold in a space. With that background, on today's show, in case anyone missed the episode we did on Upwork, we're going to put Docusign through Brian's patent-pending 6-step stock ringer. That is going to be a look at the financials, moat, potential, customers, management, and risks facing this business. And then we'll kind of wrap up talking a little bit about what we think of the stock and anything else people should be aware of. Brian, why don't we kick things off looking at the books?
Okay, so Docusign went public in April, and they raised about $629 million at their IPO before subtracting fees. A good chunk of that, about $440 million, went right into the company's bank account, and another about $150 million were used to cash out existing shareholders. After the IPO, they had over $818 million in cash on their balance sheet as of the end of the second quarter, and no debt. And then just a couple of weeks ago, they added another $500 million through a convertible note offering that closed in September. So that did bring debt into their books, but it's convertible, so it's a possibility that they might not have to pay that back. So this company has lots of cash and a little bit of debt now.
Yeah, and while there is cash in there from this IPO process, and while the company is growing a decent amount, it is currently operating at a GAAP loss, as people might expect for a relatively early stage as a service business. This is something pretty common for the space.
Yeah, Docusign is purposely operating at a small GAAP loss because they are investing aggressively into growing out their company, and specifically they're spending heavily on sales and marketing. To put the number in context, though, last quarter, which is the second quarter, they lost totaled about $36 million, which is really a drop in a bucket compared to their $1.3 billion plus in cash that they now have on their balance sheet. And it's also important to know that that loss was on a GAAP basis. If you look at their free cash flow, they actually produced $18 million in free cash flow during the same time period. So I don't think the GAAP loss is a huge issue.
Turning our gaze to the second criteria you like to look at, Brian, that is moat. And I think one of the reasons why you really focus on the SaaS space is because these products tend to be very sticky. once you get people using them, you get very comfortable using them, there are pretty high switching costs with doing that. People get used to the interface. It kind of gets built into workflows at businesses, and it's really difficult to break that once it's there.
Yeah, so DocuSign, I think, has a couple of advantages going for it that will make it continue to be the leader in the space. First off, DocuSign works with over many different tech giants and has their software embedded in 300 different pre-built integrations with some very popular programs that are made by giants like Google, Microsoft, Oracle, Salesforce. So if you want to use the DocuSign and you are using those products natively, it's a very seamless integration because it's already pre-built in. So that convenience is one of the reasons why its software is very, very sticky. And a nice metric that you can use to look at to determine how sticky it is for a SaaS business is a dollar-based net revenue retention rate, which basically says from one year to the next how much money are the same existing customers spending on with the platform. And most recently, that figure was 115%. So not only is DocuSign keeping its customers around, but its existing customers are spending more with DocuSign each and every year, and those just lead to wonderful economics over time.
Yeah, that dollar-based net retention rate number is a little wonky. People in the SaaS space know it well. If you're not familiar with it and you follow restaurant stocks, think of it as a comps number. You know, you have a store that was open a year ago, you have it open now. How are those sales performing? That rate of 115% is pretty darn high. And I think, correct me if I'm wrong, Brian, they've typically been in the 112 to 119% range with that metric. There are a lot of SaaS companies that would kill for that type of net revenue retention rate number. Most of them are slightly over 100% if they're doing okay.
Yeah, that's exactly right. And another thing that I think is working in DocuSign's favor is that its brand is extremely well known. The name DocuSign, as I mentioned before, I think is quickly becoming a verb where people say, I'm going to DocuSign something. And that just creates instant name recognition. And then another factor that's a reason that stands out is when a company is looking to adopt an e-signature platform, the name DocuSign not only instantly comes to mind, but there's a lot of social proof out there because these guys have so many customers that makes it easy for them to choose DocuSign just because they're the leader. And DocuSign has the data to show that their signature has never been challenged in the court of law. So they have the data to prove that when somebody signs using their e-signature platform, that it stands the test, that it stands up in the court of law.
All right, turning to item number 3, this is potential. And this is really just a look at, okay, what is out there in terms of a total addressable market? What is out there in terms of a customer base? It seems like this is a company that is going to benefit from some pretty strong tailwinds.
Yeah, the paper and pen, despite how long DocuSign has been out there, is still the dominant way that agreements are made in the world of business today. But DocuSign does have hundreds of thousands of customers. So as of the end of the last fiscal year, it had over 370,000 customers that were paying DocuSign, including tens of thousands of them that were in that had at least 250 employees. So these are fairly big-sized customers. And that number sounds impressive, but DocuSign believes that it's basically penetrated about 1% of its total core target market when you take all the potential agreements that are out there that are made every day. Only about 1% of them are currently made through DocuSign's platform. So management estimates that its total addressable market, when you add everything together, is about $25 billion. When you compare that to the about $518 million that it hauled in last year, there's plenty of room left for this company to grow.
Yeah, and I think there's a really big opportunity for this business internationally too. Right now, most of their revenue, I think about 80% of their revenue, is coming from the US. Management has talked a decent amount about how there's a pretty big international opportunity out there. I'm inclined to agree.
I totally agree. And DocuSign also can make use of M&A and also layer in additional services over time to expand its total addressable market too.